There's a demand coming out of China that's voracious, and Asia for both gold and silver. They have their own issues. China, in our report, we talk about China's devaluing yuan at around a 10% rate a year to keep the growth of their economy going. So people in China demand gold. So there's just a bid for gold. Central banks want gold. Commercial banks want gold once they made it money again. So there's physical demand for gold. There's a lack of trust in the system that's being worked into this. So there's a whole host of reasons why gold is still going up, none of which are good. Lack of trust in the monetary system suggests that there's a new system coming.
Rising demand for gold and silver across Asia, led by China, is reshaping global precious metals markets. Analysts note that China's ongoing currency devaluation, estimated near 10% annually, has intensified domestic demand for physical gold as citizens seek to preserve purchasing power. Central banks and commercial banks are also increasing gold holdings, reflecting declining trust in fiat-based monetary systems. According to market commentator Edward Dowd, this surge in physical demand is not speculative but structural. A growing lack of confidence in existing financial frameworks suggests a broader transition ahead, with gold and silver emerging as critical anchors in a potential new global monetary order. Now, we present the clips from Edward's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
Commercial banks are accumulating gold because they made it money again, a tier one asset. Central banks are acquiring gold. So whatever new monetary system, and again, whether that's, coming out of this next crisis we see coming or somewhere down the road, gold and silver will be part of whatever's coming. And the price is telling you that. And, if we do have a financial crisis and it goes systemic, there may be a pullback in silver and gold because there'll be a giant margin call like there was in '08. That'll be temporary. And, that would be a great time to accumulate precious metals if you already haven't. They may not go down a lot. So, again, we're in some unprecedented times. We have demographic issues and too much debt. And, that's deflationary. China's accumulating a ton of copper into inventory. Again, they're converting a lot of paper into real assets. So it may not necessarily, it seems to have somewhat disconnected from economic activity in that there's hoarding going on and large-scale purchases. Having said that, if you look at oil is telling you that China's internal consumption is not good because China was the marginal user of oil when they were growing 25% GDP growth back in '07. Their GDP growth is now around 5%. Again, they have a demographic problem. So the copper thing is interesting. And it used to be called Dr. Copper, but we've never seen oil and copper do exactly the opposite. And again, it could be a hoarding issue. Things that we used to rely on aren't working anymore. Again, we had case in point, we had well-tested early cycle indicators that worked for 30, 40 years until they didn't in 2024 when the Biden administration decided to plop 20 million illegals into the economy, print money, and give it to them, and that kind of thwarted our early cycle indicators because we've never seen that kind of economic variable. So we have a lot of things going on we've never seen before. The thing about silver and gold, especially silver, you can't print silver to meet the demand. So people want the physical delivery, and the paper guys don't have it. You can't print silver. This is an interesting dynamic, and there's a lot of speculation as to what's going on behind the scenes. And people think there are secret bailouts going on. Central banks giving money to these people to cover losses. I don't know. But certainly at some point, somebody somewhere is sitting on huge losses on the silver short. You can't, they could print money now, but that would be very inflationary and would devalue all currencies immediately. Or they can wait until the crisis occurs, and then that gives them the justification to do extraordinary things that we've never done before, like yield curve control. So, they need a crisis to try to reinflate it again, and that's what we're going to see.
Gold and silver are increasingly central to a shifting global monetary landscape, with commercial banks now treating gold as a tier one asset and central banks accelerating accumulation. Precious metals are signaling their role in any future financial system. Analysts warn that a systemic crisis could trigger short-term sell-offs from margin calls, similar to 2008, creating rare accumulation opportunities. Structural forces, excess debt, demographic decline, and asset hoarding by China in copper and gold are distorting traditional indicators like oil and Dr. Copper. Unlike fiat currency, silver cannot be printed, exposing vulnerabilities in paper markets and raising the stakes for heavily short physical positions. Let's get back to the interview.
Put aside the stock market for now. Who cares about the stock? Plumbing issues. There's issues going on with silver and gold. There's geopolitical tensions. There's a lot of things, and of course, there's a housing crisis that's starting to bubble up. Rents are dropping, which leads into home prices. Inflation is going to be a thing of the past. We'll be talking about deflation sometime next year. And then, of course, we put out a China report in October that was for institutional investors. We're going to be putting out more of a retail investor report. Still, we're not giving it away, but it's not quite the price we were asking on the other one. China's heading into an acute phase of its crisis, but despite popular opinion, they're not holding all the cards, as everyone says. In our report that'll be available probably sometime this week, it's a primer for everybody to understand what cards China holds, what cards we hold, and their real estate crisis is going to start to really accelerate in 2026. So globally, everything is kind of pointing to a big year of news, policy decisions, economic havoc, potentially kinetic things. We're already seeing we already had the abduction of Maduro, and now we have talk from Trump about taking Greenland, and who knows whether it's bluster or negotiating tactics. But Martin Armstrong, who I think you've had on your program, is talking about war, and he's got a computer model that tracks war. He says it's starting now, and demographically, we see that in our numbers. China's got lots of demographic issues. They made war to distract their policy. So there's a whole lot of things that are out of our control. But what I do know is that the cracks are showing up. And in 2025, a couple of things we got right. We predicted that interest rates would come down, especially the long end. That's begun. The 10-year when we issued our report, 4.8%. It's at 4.14 now. So that's showing you that the credit markets are starting to anticipate slowing growth in the U.S. and the globe. We also said oil would probably go to $30 at some point during this crisis. Oil's at 57. When we issued the report, it was at close to 80. So there are things, and then housing. We also talked about housing being a potential problem. That's starting to show signs that things are rolling, and we're starting to see price cuts, and it'll develop into a full-blown crisis at some point next year.
Isn't war inflationary though? If we are heading into some major war,
that's the idea. It can be inflationary, and war is a great distraction from problems at home. But the China is exporting deflation. In our report, you see what's going on with them demographically. They are struggling mightily. They overbuilt their housing supply by decades. We're not talking, 5 years of inventory. We're talking 20, 25 inventory to clear out. They are in a demographic decline, working age population declining 1% per year into 2020, 2032. And they already have a real estate crisis that's ongoing. It's about to go and get worse because they've been trying to export their way out of their problems. And that's one of the obviously problem with the Trump administration. And so China's exporting deflation. Unemployment is going to rise. We're seeing the employment numbers held up by illegal immigration start rolling over, and just fraud and statistical incompetence. The credit markets are going to see this going forward, and the U.S. consumers, especially class consumers, tapped out. Credit card delinquencies are at crisis levels. Auto delinquencies are there. Next will come mortgage. So the consumers the middle class consumers tapped out. There's still some savings amongst the rich that are still kind of supporting the economy, the K-shaped economy. The AI data center infrastructure build out has contributed about half of the people we've seen this year. But that's all infrastructure build with no revenues to support it yet. And we suspect at some point, the credit markets will put a pause on that until the infrastructure resets in price. And what we're starting to see is we saw Oracle credit default swaps rise, CoreWeave credit default swaps rise. And so there's an issue in the financing of the AI and also power constraints. And if there's no power to hook these data centers into, why build them? Why not delay them? So I think this is the year that massive pause in AI capex appears, and we see the whole AI bubble start to unravel.
Global fault lines are widening as stresses emerge across commodities, housing, geopolitics, and credit markets. Analysts warn that silver and gold face structural plumbing issues just as deflationary forces replace inflation. China's deepening real estate and demographic crisis is expected to accelerate in 2026, exporting deflation worldwide. Falling rents, rising delinquencies, and weakening credit markets signal a broader slowdown. Meanwhile, geopolitical risks and war rhetoric add uncertainty, even as long-term interest rates fall and oil prices slide. Cracks in housing, AI-driven capital spending, and consumer finances suggest 2025-2026 could mark a pivotal economic reset with heightened volatility across all asset classes. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.